Alright guys, so this is probably going to be my last update video for second quarter earnings, mostly because we've already covered most of the big popular stocks that have reported, but I wanted to do just one more for you guys because we just had the red hot AI chips giant Nvidia report, who I frequently get asked to share my opinion on just because they've been on fire lately. So we'll talk about their earnings report, but just to add a little more variety to today's video, I like to cover a few different stocks for when I do like an earnings update. So I'm also going to throw in Zoom Communications. They were red hot during the pandemic, but have now crashed into the ground. I'll let you know if I consider this a good turnaround play here at these lower prices. I'll also throw in a couple of legacy retail dividend stocks that I sometimes get asked to talk about. Never really cover them on the channel, but that would be Lowe's, who is a dividend king. And we'll also cover Macy's and their earnings report, who is a department store retailer who really has been crashing into the ground for years now. And they also have a very big dividend. So I'll share my thoughts on all of those stocks. Sometimes I get asked to talk about them, don't really cover them much on the channel. So we'll be doing that in today's video. I hope you enjoy it. We'll cover these stocks, their earnings report, how the markets reacted to their reports, and I'll let you know if I consider any of these stocks to buy at today's prices. So it's going to be a lot of fun. Hope you enjoy it. Last earnings update video for second quarter, but let's go ahead and just jump straight into this list of 4 stocks here. All right, now as usual, we'll be going in chronological order here, and right off the bat, I gotta just really quick apologize for being so late on this video because I actually wanted to get it out during the weekend, but I had some stuff come up, so it got a little delayed. But essentially, all these companies reported earnings last week, and we had Zoom report on Monday, then Lowe's and Macy's both reported on Tuesday, and then we had Nvidia report on Wednesday. So we'll start first here with Zoom Video Communications, ticker symbol ZM, who, by the way, has been one of Cathie Wood's favorite stocks to buy. In fact, it's the 3rd largest holding in her flagship ARK Innovation ETF. And you can also see here how as the price declined in Zoom, Cathie purchased more and more of the stock. Unfortunately, this past week didn't see things improve too much in terms of the stock price performance, as it actually fell initially after their earnings report, but later recovered a bit to finish the week slightly positive. However, from the top, Zoom has now gone from trading at almost $600 a share during the height of the pandemic, where everyone was working and learning from home using Zoom software, to now crashing by almost 90%, down to just $67 today. That's from $600 down to $67. That's pretty crazy. And that's happened, of course, as the pandemic has faded away and people have largely returned to in-person activities. So is the stock a buy now? Well, the quarter was actually pretty strong as they beat analyst expectations on both sales and profits, while also returning to growth, with sales rising a bit at 3.5%, while operating income also rose by close to 50%, and they even raised their full year guidance, citing stronger than expected performance in their enterprise business. However, if you dig deeper into the report, you'll find that enterprise revenues only rose by 1% year over year, which to me shows that their macro environment is still pretty weak right now as they deal with heavier competition that are all vying for the attention of various businesses. Don't get me wrong, Zoom is still the leader in the space with hundreds of millions of users, but their growth is a tiny fraction of what it used to be. Again, sales only rose by less than 4% in the quarter. You got to contrast that with a couple years ago where it was multiplied by almost 5 times the amount. And while the giant sales from the pandemic are still mostly here, profits have actually been struggling, with marketing costs continuing to rise as they try to fend off the growing competition from other tech giants like Microsoft with Teams, there's Google with Meet, and there's even Teladoc Health for telemedicine. Coupled with the tough comparison from the pandemic years, Zoom is only expected to grow sales now by around 2 to 3% in each of the next 2 years, while EPS went from over 100% growth in the previous 5 years down to slightly negative growth expected over the next 5. And yet the valuation is still pretty rich here at a price to sales ratio of almost 5 and a PEG ratio of over 6. And I'm not saying that those other platforms are necessarily better. I think Zoom is a great platform with really strong technology and still a lot of future promise, especially in AI, where they recently launched a new generative AI feature that records your meetings and gives you detailed summaries at the end that can help you or your organization run more efficiently and better plan out your schedules and call back to certain notes and all kinds of other analytical things that it can do. It's all very impressive. And with the stock down so much, I can totally understand taking a chance on this stock here at today's much lower prices as kind of like a turnaround play. However, the reason why I personally won't invest in Zoom is because it just doesn't make sense to me when I can get such larger, more diversified businesses like Microsoft or Google that do like 200 or 300 times more in operating profits, and yet their valuation is less than half as expensive as that of Zoom's by a PEG ratio. So I actually think those stocks are the overall better ones to be buying right now as long-term investments. Moving on to Tuesday though, we had a couple of big retailers report in Lowe's and Macy's, ticker symbol LOW and ticker symbol M, both of which were historically known for being pretty good dividend payers as well. In fact, in the case of Lowe's, they've now increased their dividend for nearly 6 decades in a row, and yet it still carries some fantastic growth metrics on it too, like a whopping 20% 5-year growth rate and a very small payout ratio of only 30%. And as such, I'm usually asked why I don't invest in this stock myself for that, very attractive dividend. Well, I would say that the biggest drawback to it is that the yield is just, pretty small at just about 2%, which you would really have to wait many years until it grows into something more substantial. I mean, it's got some good growth rates, but you have to wait a while until it gets a lot bigger, which again, more growth-oriented dividend investors aren't going to be, minding too much to wait for that. But I usually like to have a better balance between yield and growth right away. As you would expect with such a massive growth history though, Lowe's financials have also been very strong over the years, especially during the pandemic, as one of the largest home improvement retailers in the country, really only trailing their bigger rival in Home Depot. Now, Macy's, on the other hand, has had a much more volatile history, as the department store retailer has been struggling in recent years because of the retail apocalypse that has left shopping malls with very little foot traffic these days, if they're even still open, and as such, their sales are actually less than they were an entire decade ago. Usually sales go up over time, but not in the case of Macy's. They've really gone down. And in fact, during the pandemic, where many retailers actually saw an increase to sales, instead Macy's saw a decline to both sales and profits, again, because of the lower foot traffic in malls, but also because of lockdowns and because of their higher priced non-essential items, which, by the way, caused them to lay off thousands of workers and cut their dividend during that time. Since then, though, their financials have actually recovered back up to more normal levels, and the dividend is still yielding about 5.5% today, which is a super attractive yield, and with still a pretty small payout ratio too. So normally I would say, this might be a great time to be jumping in on a stock like this thanks to that rebound. However, as we just saw from their earnings report, retailers are actually having a really tough time right now in the current macroeconomy. In fact, Lowe's saw almost a 10% drop year over year on both the top and bottom line last quarter, while Macy's saw the same drop on sales and almost a 70% drop in operating profits too, which is in large part because they're having to put so much of their product on clearance, and thus it's damaging their margins. And many other retailers are going through similar challenges too, like Dick's Sporting Goods and Target and several others. In the case of Macy's, they noted in the earnings report that consumers have less cash to spend with rising financial pressure from higher interest rates, higher credit card balances, and also the need to start paying back student loans. All of these headwinds are really weighing down on the consumer, and it's hurting their business. They also noted that consumers are choosing experiences over products right now, which I would say does make some sense given the pent-up demand for travel and other outdoor activities coming out of the pandemic lockdowns. And we've even seen that elsewhere in the quarter with many airlines posting near record high flights. Lowe's also noted that homeowners are taking on fewer home improvement projects, which again also makes sense as less people are working from home like they did during the pandemic. And Dick's Sporting Goods also reported a huge increase to theft, which is something that a lot of other retailers are also struggling with in certain parts of the country where robbers are not, necessarily being prosecuted. And in fact, Target CEO noted in their earnings call the week prior that incidents of violence have more than doubled through the first half of the year and is costing them over $1 billion in losses. That's pretty crazy. Really, the only retailer that does seem to be benefiting from this weak macroeconomy are lower priced retailers like Walmart, for example, who noted in their earnings report that customers are stretching their dollars further and seeking better value across more categories, which is driving more foot traffic to their stores and thus increasing their sales. So much so, in fact, that they actually raised their full year guidance. Back to Lowe's and Macy's though, Lowe's stock was about flat for the week and continues to trade near an all-time high. So considering how small their dividend yield is and how their sales are actually expected to decline by almost 10% this year, I just think there's much better options out there with more stable businesses and larger dividends. I will say though that Macy's does look a bit more interesting as like a turnaround play, at least on paper, having now crashed another 20% this past week, leaving it down over 80% from the top and currently trading right near a decade low. I think the only time that it was lower was right around when the pandemic hit, but this now leaves them with a dirt cheap valuation at about 70% cheaper than the sector. But while the 5.5% dividend is really tempting to jump on, I just don't see how Macy's business is going to survive over the longer term. Which, if you're like me and you're a very long-term minded investor, well, you'd have to be worried about the negative revenue growth that is expected in each of the next 2 years. I'd personally rather invest in something like Amazon for growth, or even if I wanted retail dividends, I think stocks like Verizon, Walgreens, or Tyson Foods have more turnaround potential with stickier businesses, and they have still really good dividends, especially Verizon at almost an 8% yield. And I've actually been buying all three of those this year. They do have their own risks and challenges themselves, but I just think overall they're kind of a little safer than something like Macy's. But let me know if you'd consider ever taking a chance on this legacy department store retailer yourself. I'd love to hear your thoughts. Anyway, guys, that's going to leave us now with the final stock to run through, which is the only one on the list that I actually own myself too. And that is, of course, the AI and semiconductor specialist Nvidia, ticker symbol NVDA, who's really been gaining a lot of steam lately, having now soared by over 200% just this year alone, leaving it trading right near a record high. And that amazing performance didn't seem to slow it down this past week either, as they climbed another 6% on what I feel was absolutely amazing earnings, where they not only shattered analysts' expectations, beating on EPS by almost 30% and revenues by over 20%, but they also more than doubled their sales year over year while growing their net income and EPS by another 800% plus as well. So just outstanding performance overall. And that was mostly thanks to the recent AI craze that has really convinced a lot of giant companies, especially those in cloud computing, to upgrade their hardware ahead of the looming AI revolution that is sending demand for Nvidia's AI chips through the roof, especially their A100 and H100 GPUs that are used for server AI and machine learning, which during the earnings call, Nvidia CEO stated the world has something along the lines of about $1 trillion worth of data centers installed in the cloud, enterprise, and otherwise. And that $1 trillion of data centers is in the process of transitioning into accelerated computing and generative AI. Well, Nvidia, of course, is a specialist in both of those areas, where their investments for years into GPUs are now accelerating the computing performance of systems by an order of magnitude greater than what CPUs can only do on their own. And in generative AI, Nvidia chips are not only being used already by companies like OpenAI and Microsoft that use them to power ChatGPT, but the future potential is really large there as well. In fact, during the quarter, tons of companies have been talking about how they're implementing generative artificial intelligence into their own businesses in order to improve efficiencies and power technological breakthroughs. And because of that increased demand from practically everyone, Nvidia was able to see their data center and AI segment rise by nearly 3 times the amount in sales year over year. And in total, Nvidia had previously estimated that their addressable market should be worth around $1 trillion, which is 37 times larger than the 27 billion that they did in sales last year. And this year, they're expecting sales to continue rising up to over 50 billion, as they noted in the earnings call that they already have so many orders and so many companies reaching out to them to upgrade their systems that they can see several years into the future of high demand for their chips. The problem, however, is that Nvidia has been known to see some big volatility in their growth rates at times, and while I am extremely bullish on their AI prospects myself, we have to still acknowledge that the stock's market cap has now surpassed over $1 trillion, which is, really puts it into similar territory as other tech giants like Amazon, Google, and Microsoft. Yet Nvidia only does tens of billions in sales, while those other giants do hundreds of billions by comparison. And that's a pretty scary sight. In fact, based on profits, Nvidia also trades over 80% more expensive than the sector on a forward P ratio basis. However, the reason why I'm probably more optimistic than most is because of their insane growth and their strong margins, which is why their price to earnings to growth ratio is actually about 30% cheaper than the sector, even at these higher prices. In the quarter, they did over 45% net income margins, which is super strong. And if they can maintain it to at least a similar level, and considering their giant addressable market, the stock might actually be pretty cheap right now when looking back on it, years into the future. However, as it stands, Nvidia is already my third largest stock, which I am up over 800% on. So I'm not really looking to add any more shares at this time, but like I've said before, and I'll continue to say this, if I wasn't already in the stock, I would probably buy some here and then just adjust my position over time and add more shares on future dips, because I just see so much future potential for them that I wouldn't want to be, left out of it. If you're looking for something a bit cheaper though, but with also a lot of future promise in the AI chip space, then you might want to take a look at some of these other stocks like Taiwan Semiconductor, Broadcom, Intel, AMD, Applied Materials, or several others that also have pretty, strong and diversified businesses, but trade for a fraction of the market cap that Nvidia currently commands. But anyway, what do you all think? Are any of you picking up Nvidia stock or any of the other stocks that we talked about in today's video? Share your thoughts with me down in the comment section. We can have a conversation. And thank you for all the support, my friends. I hope you're all doing well, but I will catch you in the next video. Take care, everybody. Bye-bye.